Hey guys, we're going to take a look at last week and some fascinating differences between PPI and CPI. We'll get into the Mission Consumer Survey. And then finally, we'll get into where the market may be headed and then look at some stuff for next week. All right, so with that, let's jump in. All right, so first we'll take a look at the CPI. CPI last week was rather benign. It kind of came in line with expectations. You can see here the consensus was 2.8. Year over year came in at 2.7. 3 for the core and 3.1 was the actual. So the market really didn't sort of pass this one off. It didn't really go into it. Let's jump into the actual report. And you can see that all items was 2.7. That's the headline. And then the core is all items less food and energy, which is this one here. And you can see that there's a lot of deflationary components. This part doesn't matter because this can be very volatile. Energy and food can be very volatile. But what's more important is the core. So 3.1, and then you've got some commodities at 1.2. New vehicles came in at 4.4. Used cars and trucks was a big one. This represents probably about 8% of CPI. That came in 4.8% year over year. That is a little bit high, but what's really fascinating is this component here is shelter, 3.7. This still is continuing to work its way down, but this represents about 35% of CPI. Let's jump into that because I want to show some pretty interesting things that show why shelter should be lower than what it is. All right, first, I've shared this before, but if you look at the way Zillow observes rent and the way BLS observes rent, they are two different things. So going back into 2023, you can see where Zillow year over year increases in rent was around that 67%. And then it flatlined around 3%. That's kind of the historical average, and that's kind of what you expect. And then over the last few months, it's actually been dropping. This was up through June. It's actually sub 3% year over year for observed rent. The way BLS does it is they're always in arrears. It's kind of like a rolling 12 months. But what's even more fascinating is this. So there are two components that make up BLS shelter. There is the actual rent, which is about 7-8% of CPI, and then there's the owner's equivalent rent, which is made up of a survey, which is what people think they can get for rent. And that represents 26% of CPI. And it's usually wrong because it's old data and it's what people think they can get. And here's why. Going back into 2019 and 2020, the blue line represents the actual rent. This is what BLS, they do capture actual rent, even though it's on a rolling 12-month basis. And they were showing that that's around 3.5%. People didn't think they could get that much for their house, and so they were a little bit lower. Think of it this way. Here's how the survey works. Let me jump into that first. The survey is sent to people who own homes, and then they ask me as a homeowner, what do you think you can get for rent? So I'm going to pencil in something what I think I can get for rent. They send this out to thousands of people, and they track that on a monthly basis. The problem is it's what I think I can get. It's a survey. So now let's go back to 2021 after COVID. So rent starts going up, actual rent starts going up. People are realizing, hey, I can get more rent. So it actually kind of led actual rent. But then it started falling behind. And in 23, actual rent observed was much higher, almost 9% year over year. People were saying, hey, I can get this, but they didn't realize they can get even more. So they were penciling in almost the wrong number, if you will. Then fast forward another year or so, and look, actual rent is actually falling faster, but people aren't catching up yet. The surveys are still filling out a higher number than what is actual. And it's also lagging because it's 12 months in arrears. Or 11 months in arrears. So it's that rolling 12 month. So at this point, here we are in July, or in August, but it's for a July number. Actual rent actually dropped a lot. But what people are putting in the surveys are still up. So 26% of CPI represents this number right here, which is wrong. It's based on people's feelings. So give it time. This will catch up, and this will catch up to Zillow, what we saw just a minute ago, where it was less than 3%. We're right now hugging around 4% perception, 3.5% for reality. So we still got a percent to go. That together, those two numbers together represent 35% of CPI, and that's a big number. So, mathematically speaking, it's going to, when it drops to 3%, that's going to have a pretty big effect on CPI and may actually show less than the 2% target that the Fed is actually trying to hit. We saw that a second ago, where basically the only thing that was really high was used cars and trucks. That can be kind of volatile as well. So fascinating, right? Let's go into PPI. So fast forward, that was Tuesday. Then on Thursday, we got PPI, which measures a whole different set of things. Let's go into that. PPI final demand. A lot of people, there's a misperception out in the market. People think PPI is what wholesalers are paying for their goods, and then they pass it on. It's not quite what it is. CPI measures things from the consumer's perspective, what I'm paying, and PPI measures what the seller is receiving. So it's just exact opposite. It's the opposite side of the transaction. It is not what wholesalers and retailers are paying for their wholesale. It is not that at all. It is strictly what they're receiving, and it has different products. We'll get into that in a second. But if you look at final demand services down here, 1.1, this number here is what got people a little bit spooked on Thursday. And markets actually, for the interest rate side, actually rates started rising because of this number here. This was the highest number since March of 2022. That did spook a lot of people. This number here, 50% of this is trade. So it's not trade in thinking of things like trade with this country versus that country. This is actually measuring margins. Think of it this way. If I'm buying a shirt for $20 and I turn around and I sell it for $30, it's a $10 markup. If next month, that's what they're measuring, that $10 mark. If next month I sell that shirt for $35, that's a $15 markup. What trade is representing is measuring the two differences between the 10 and the 15. So that's where that increase went. And inside of that, if you dive into that, that actually represented machinery and equipment. So those aren't things that's paid by the consumer, that's paid by the business. 30% of it was machinery. Machinery jumped like 3.8%. So this will eventually get into product markup, but it's going to be based on a per unit basis. If I'm buying some machinery to make bread, that's a capital expense. It's going to be represented in that unit cost over time and over a long time. So it's not a direct correlation to inflation going up. But people think it is, and it sort of spooked the market. My belief is this is probably a little bit of a seasonal thing. I'll show you that here in a minute. But that's what that's measuring, not trade as in tariffs and things like that. Okay, so speaking of PPI and CPI, let's look at some of the differences. PPI measures changes from the seller's perspective, not the buyer. CPI is only the buyer, what households are paying. PPI is what businesses, government, everybody's paying. So it's a much broader scope. PPI measures U.S. producers only and does not care where the product is sold. CPI, on the other hand, does not care where the product comes from and also includes imports, and it only represents urban customers. PPI is much broader, includes capital equipment like machinery, and it includes things like insurance, medical costs. For example, if you have a medical expense, your insurance is going to pay a lot of that, whereas you don't, but PPI will measure that. It measures top-line revenue received by the domestic producer. CPI measures from the consumer side. Taxes are not included in PPI, whereas taxes are included. So sales tax and any other tax, that gets included in CPI. Weights are different. We talked about like 35% of CPI is made up of that shelter. Well, that's not even included in PPI. There's no shelter component in PPI. It's different things. And there are different weights. The U.S. Census measures PPI and BLS measures CPI. So the scope is different. Owner's equivalent rent, shelter, housing, none of that is included in CPI. And then again, unique components, machinery, things like don't get included in CPI are included in PPI. The other thing is there are price divergences within the two. So I've got core CPI, core PPI put together here. The blue line is PPI, green line is CPI. So you can see that PPI can go up and CPI does not reflect that. PPI can go down and CPI may not go down as much. So this is not a cause and effect is what I'm trying to illustrate here, is that there are divergences. And also look at here. Last year we had PPI increase, CPI did not increase. So here we are. Are we getting an increase? Is it a seasonal thing, like something we experienced last year? Who knows? But don't expect PPI just because it went up a whole bunch. Doesn't mean CPI is going to go up a bunch. Just kind of keep that in mind. All right. Retail sales came out on Friday. This came in as expected at 0.5. Bottom line is consumers still strong and they're spending money like crazy. Michigan Consumer Survey came out on Friday at 9, and this did shrink somewhat. Let's take a look at what the consumer is feeling. This is another survey that goes out to thousands of people. They measure how people are feeling, because feelings can translate into how people spend. But one notable thing is unemployment and inflation expectations are worsening. So people are thinking that unemployment's going to worsen and inflation's going to go up. But if you look at the last, look at April and May, they were thinking it was going to be way worse than it is. It came down, but now it's kind of going back up. I kind of agree with this a little bit. I don't agree with the inflation side. I agree with the unemployment side. We saw unemployment a couple weeks ago. I think there's some weakening, and there'll be further weakening. I'll get into that here in a minute. All right, so where's the market? Where's the market today? I told you I was shorting the market, but I did give some upside cap. So I was shorting. I'm going to break even anywhere above here, but I'm shorting if it goes down. I do want to show that, look at this. That is your earnings per share, 282.82. So it went up again. It's been going up. If you go back into July, look, strong earnings, strong earnings. PE is simply the market price divided by the earnings, and that gives you your PE ratio. So you got a 22.9 PE, which is really super high. Even back in February when we were reaching all-time highs, it did not get up to 22.9. So 23 is a very high number. Earnings are good though, and the market, it's only got one direction right now, up, and it doesn't take bad news at all. I don't know how long that's going to continue. So look, let me show you a couple things. Equity risk premium is 4.36. That's basically doing 1 divided by 22.9. That's essentially saying that if I were to buy the entire universe of the S&P and how many earnings per share I get, or earnings per dollar I make, I would get a 4.36% yield. It's called earnings yield. 4.36 is what I'm going to make. And that has some risk associated with it. The 10-year yield is 4.32. So I could go put my $100,000 in a 10-year, and I'm going to make 4.32%, or I can put my money to work in the market, and my earnings yield is only 4.36. That is very low. If I'm going to carry equity, which has risk, I would want that thing to be higher. So something has to change with the price of the market. Either it comes down to make it a little bit more palatable from an equity risk premium perspective, or if it keeps going up, why not stick your money into the 10-year and get it risk-free? The 2-year rate right now is 3.76. The overnight rate is 4.33. This is where the market thinks rates are headed over the next few months. 92% chance of a rate cut in September. I agree. There are some whispers that there might be a 50 basis point cut. Well, with PPI the other day, not sure about that, but it wouldn't surprise me either. They're going to have to do some catching up because it is very restrictive where it's at, especially with unemployment. Now, they have 4 or 5 cuts priced in all the way through next year, September, October, 5 cuts. I think that's a little bit light. That is why I'm long on the 2-year. I am long on the 2-year. You can go out and buy this directly and go buy the overnight rate because it's saying it's settling down at 3. That's only 5 cuts. If you have worsening unemployment, you'll see a bigger cut than that. Another thing that we haven't talked about is layoffs. Remember back in January, February, when there was the offer to a lot of people to take a severance package. So they got an 8-month severance package. Those people have not been counted in unemployment. How many of those people, I think there were 300,000 or 400,000 people that received that severance package, how many of those have gotten jobs? I don't know. We'll see September, October, when that finally becomes known. We will see if all 400,000 people got jobs, or are they still looking for jobs? I was talking to someone the other day that it was affected. They're still living off that severance. They have not found a job. So I expect those numbers to start showing up in the September, October unemployment. One other note is do not expect mortgage rates to fall. If the Fed cuts, don't expect mortgage rates to follow suit. And this is because it is the long end of the curve. You've got debt, like the one big beautiful bill. You've got inflation expectations still built in. So I do expect the 10-year, the 20-year to sort of hover where they are. The 10-year is around 4.32. It might drop, might go down to 4, but unless there's a recession or something like that, it's not going to drop much further. The mortgage rates are tied to the 10-year. Think of about 200 to 300 basis points above that. So that means mortgages are going to stay in that 6 to 7% range. I don't expect it to fall much further unless really bad news comes in. One more thing. This line, I put this line here. This represents the seasonal trend of the last 25 years. We are coming into the worst time of the year for the market. Typically, I talked about this last week, September effect. There is it's almost a self-fulfilling prophecy where people are thinking we're at the worst time of the year. People are rebalancing, companies are rebalancing because their fiscal year starts October 1st. So there's a lot of selling and things that happened in that September timeframe. So this is a seasonal trend. Take it for what it's worth. It is not a predictor. I am shorting the market, carefully shorting the market, because the market seems to only have one direction. So I'm very carefully and tactically shorting the market. Let's go into next week. A couple of big things. You got the FOMC minutes on Wednesday. A couple of things related to housing if you're in housing stocks. And then the big one, Jerome Powell speaks at the Jackson Hole Symposium on Friday. Watch that one. That one will be the day that if rates of the market moves, that will be the day. It could be fairly benign, but there's some seasonal effects coming in, so it may also drop. It may go up. Who knows? Don't predict the market. Just react. With that, happy trading, and we'll see you next week.